Good evening, it's Doc Severson for the Theo Night Report for Tuesday, July 5th. I'll start out tonight with the S&P futures here and a couple of things to notice here on this chart. This is just the daily chart of the S&P futures, but what we're starting to see is the realized volatility. Realized volatility is also called the historical volatility, but I think realized is actually a better name for that because it implies the difference between that and the implied volatility, which is part of the option chain. So the realized volatility is what we actually see happening with the price. And we saw this sort of low volatility pullback here as we got into May, and then we started to see this shoot up and down and up and down and back up again. And so you're starting to see the very formation of what's called a broadening pattern or a megaphone pattern, however you want to call it. But really what it's showing is, in engineering parlance, is called an undamped oscillation. And this is where you get something that starts to get small and then gets bigger and bigger and bigger. It's kind of like feedback while you're at a concert. So it's kind of the signature of a very unstable system and something to keep your eyes out for here, because usually this is a bearish pattern, especially if this sets up with a lower high and starts to sell down here. Again, after this rally, we're going to have, once again, too many people on the wrong side of the boat with too large of a position. What we're also seeing here on the S&P is that regardless of this extraordinary rally that we've seen just over the last 4 days, we still have an IV percentile of 57%. So this is in the upper half of the volatility that we've seen over the course of the last year. And you got to keep in mind, this is counting periods like this in last August and also here in January, where we had some very, very strong sell-offs. So for this implied volatility to be this high relative to the previous year is telling us something right now, is that the options market is showing all this uncertainty in here. And we're going to start to see these events come pretty soon to unfold. And there's really not much that the Fed can do about this. Like, what happens if the jobs report coming up this Friday is bad again? It's not like the Fed's going to be able to stem the bleeding if they cut rates by a quarter point. So that's the S&P, and again, the thing to keep in mind here is that we still have, as of today, with today's outside bar, we still have a lower high setting up here, and sometimes the lower highs can, when they print, can cause some very, very strong volatility from here. So again, keep your eyes on this wedge pattern here because it's giving us a kind of an ominous signature. Now here's the daily chart of the ETF of the 20-year Treasury bonds, and really I don't think looking at the daily chart is giving us enough perspective here. So if we actually zoom out to the monthly chart, we can start to see really what's going on here. Over the last 10 years or so, we've seen this sort of start to move higher, and you can see just with your eye that we're starting to get into a nearly vertical rise for the TLT. And we know through watching charts again and again throughout the years that whenever we see this nearly infinite slope to the upside, this causes pain on the back end of it. We can see the same thing happening here back in 2011 with silver. So silver started to go crazy here, as this is where the Fed first started announcing right around this area here that they were going to start printing at the Jackson Hole Conference right around August or so of 2011 or 2010, excuse me. They announced the formation of quantitative easing, and it was sort of the first time that the Fed had actually said, yep, we're actually increasing the money supply. And the markets went nuts expecting inflation. So anytime you see a market rising into a bubble like this, be very, very afraid, because in this case we set up with that lower high here as we got into the spring of 2011, and it was all over since then. Now it's starting to recover some since that point, but you can see the damage that this causes when we have a runaway market like we do in the TLT right now. So we saw the same thing to some degree, not to the same degree as silver in 2010 and 2011. But here's GLD or gold that we saw in the latter part of 2011 have a really bad day. And then of course, as we get into things like crude oil, so crude oil back in 2008 was going absolutely ballistic, was going definitely into a bubble as we got into 2008, as they started talking about peak oil and this is it, this is all we're going to be able to get out of the planet. And then what happened after that, of course, was the recession absolutely cut demand. So anytime that we see a market doing something like this, we are going to have difficulty on the back end of it. Now, what that starts usually when people learn about something like this, they start saying, hey, let's short it, let's short it. And that actually causes part of the problem, because what happens is they start to see the market heading away like this. Then not only is a market attracting new longs, because you have institutions basically holding their nose and just jumping on board in a search for yield. They're usually so far behind in performance for the year, they have no choice but to jump on board. And then you've also got the the speculative shorts that jump on board and say, well, this has got to be the top. And then what they find out is a little while later, they say, oops, I guess not. We're going to have to cover. And the physical act of covering helps to push the market higher. So you really run into a perfect storm on the way up there. So it's not worth, it's just like trying to catch a falling knife. You got a rising knife here that there's no way you want to get in front of this thing. So what you've got to wait for is for the charts to show lower highs and show a destruction of the trend to the upside before it's really, really safe to take any kind of a bearish trade to the downside on here. So with markets flying around like this, one of the things that we're trying to do here at TheoTRADE is to put traders into the safest possible position that are risk managed from day one. So we're not a big believer of setting up these, huge, wild, out of the money spread positions that have a great probability of success, but also at the same time have a terrible risk reward. We think it's far more important to set people up into trades where they have the greatest possible success. One of these is what we call the in-out spread. So what we do with a trade like this is, again, set up the risk reward to be basically 1-to-1 on here with a very high probability of success, actually, of reaching an intermediate target. So we don't really necessarily care about the expiration graph. What we're looking for is just quick, short targets where we're looking for about a 50% return on this trade and setting ourselves up with a very high probability of success of hitting that mark. The other thing, too, besides that, is that we're setting ourselves up with a very neutral trade, a very benign trade in terms of the Greeks, where we don't have to worry about the passage of time that much, nor do we have to worry about really big changes in implied volatility. So if we can reduce the number of variables and make this just a directional trade only, and then even within that direction, offer some very conservative targets for us to be successful with, we can really help improve the probability of success for that trader as well as their confidence. So especially in this time where we're looking at potential titanic volatility coming into the markets and staying for probably quite a long time, now is the time to learn the basic building blocks of simple trades like this, which build confidence and not necessarily create heroes out there. So we are doing several trades like this every week within the trading room at TheoTRADE. So if you don't know how to do something simple like this to increase the probability of your success, please join us in the trading room, and we'll be happy to share these with you and get you on your way. That's it for today's report. Thanks for listening, folks. We'll see you soon.